Hello everyone, my name is John Locke from LockeInYourSuccess.com, and I'd like to welcome you to the winning trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation, we will be going over hypothetical computer-simulated trades and results. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name's John Locke. I'm a trading performance and success coach with Locke in Your Success LLC, where myself and my team are here to help you win in life and in the markets as well. And today I'm here to guide you into the realm of high probability income trading. Now in a moment, not now, but in a moment, we will be going over the winning trade. But before I do, let me tell you what we mean when we say an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in our direction, meaning we can often make money whether the market goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it does mean that we have a much better probability of winning than we would otherwise. Now, when you find that you want more information as you're following along, simply contact us at lockeinyoursuccess.com or ask a question in the comments on this video below, and we can direct you to where you can find more information. So let's move on. The winning trade we're going to be discussing today is known as the bear trade. And this bear trade is an income strategy that we trade on the Russell 2000, and we track in our Go membership on our Monday morning options trading for income webinars. This is a strategy that is best utilized or takes advantage of a variety of markets, such as overextended uptrending markets, volatile and very volatile sideways markets, as well as volatile and non-volatile downtrending markets. So it is effective in many, many different types of market situations. Now, this trading strategy is going to require a minimum of $5,000 planned capital, and it's going to have a 30% profit target and a 30% maximum loss. Our trade size today is going to be $5,000, and our maximum loss in that case is going to be $1,500, and our profit target will be $1,500. Of course, there are other reasons to exit the strategy other than profit target or maximum loss, as you'll see in the demonstration. So let's jump in and take a look at the strategy. For those of you who may be new, this is an analytical software that analyzes the profit and loss characteristics of a particular position. And what we have here is we have an analytical graph that shows us a graphical representation of when we make or lose money and how the position may change value over time and with price movement. On the left here, we have our options chains. So here is our September, our October monthly, and our November monthly. We are going to be trading the October monthly cycle. The cycle will be 56 days to expiration, and the date on entry is going to be Friday, August 21st, 2020. So our October expiration, as I said, is 56 days to expiration. What we're going to do is we're going to enter an iron butterfly. And for those of you who don't know what that is, it's selling options, two options at the same strike, and then buying options to cover your risk at different strikes. So this is going to be a 50-point wing, they call it iron butterfly. So we're going to be selling the 1530 options, and we're going to be doing that when the asset price is at 1549. Then we're going to be buying our 1580 call option to cover our short call, and then we're going to be buying a 1480 put option to cover our short put. That's going to give us an analytical graph that looks like this. So what this means is we have this blue triangular shaped line. This is known as the expiration line, and it represents the value at expiration of the position. So we have our profit and loss here up the right side. And on expiration day, which is going to be October 16th, 2020, if we were to hit exactly, if the asset price were to be exactly 1530, then we would have a profit somewhere around $4,200. Now, that's not going to happen because we don't let the trade go that long, but that theoretically is what that means. And of course, if the asset price was out here on expiration and we did nothing, then this would be at a little over $500 loss. So that's what that line is telling us. It's telling us the value of this when the position expires. It's also telling us how much capital we have in the trade or how much risk potential we have. So currently in this position, this trade has about $600 worth of risk. Now, this is a $5,000 planned capital position. We wouldn't get $5,000 in this position ever in this type of a market, because in this type of a market, the iron butterflies are very inexpensive to buy. If you get in a low implied volatility environment or get very, very close to expiration, these are going to be much more expensive. So as the trade goes along, we are going to be adding butterflies in this. So for example, we're going to start with this butterfly here, and then we're going to have what we call trigger points to scale into the position. So as the market goes up to, in this case here, we're at 1530. If we get up to 1570, we're going to be adding another butterfly. If we get it up to 1590, we're going to be adding another butterfly. And then if the market continues to go up, what we're going to do is we're going to start rolling butterflies. So the position scales in and increases size a little bit up to triple its size, and then we stop. Right? We don't put any more. We don't increase the position size anymore after that. We just kind of wait, or we roll to stay up with the market up to a certain point. And if we end up hitting our maximum loss number of $1,500 in this case, we would take it. If we hit our profit target of $1,500, we would take it. We're also going to exit when our November cycle gets 56 days to expiration, or our October cycle hits 21 days to expiration. That's another reason to exit. So we have multiple reasons to exit. And of course, the last reason to exit here would be if we get down to the long strike on our lowest butterfly. In other words, if this market were to come here and we were to drop right back down below 1480, then we would end up just exiting this position at a profit for the month and then going into the next cycle. So what we want to happen is we want the market to come up a little bit, maybe 40 to 60 points, and then kind of range in a range for a little bit, hit our profit target and get out. That would be the ultimate trade. It does happen several times a year. A lot of the time we're going to take something maybe a little bit below profit target, or we're going to get whacked out to the downside when we come past our long strike here. So that's usually how the trade plays out. There is no rollback adjustment. There are downside adjustments once we get scaled in, which we'll show you for the presentation. So it's a very, very simple strategy, really. So here we are. We execute this trade here where we sell this iron butterfly 1530 with 50-point wings, with the short strikes approximately 20 points below the market. And again, we're going to have add points. We're going to add when the market gets to 1570 and when it gets to 1590 if it gets there. And we're going to stop out at this point if the asset price goes under 1480. So let's take a look here at how this goes. I'm just going to go to the first adjustment. So we end up getting an upward price movement. We have an add point at 1570. The asset price here is at 1574. That being the case, we're going to scale into our second third. And the way we're going to do that is we're going to just simply go 20 points higher. So we're at 1530s with our original iron butterfly. We're going to pop up to 1550 and do another 50-point wing butterfly at 1550. And now our total capital in the position is going to be, what, about 1250 at this point. If the market were to continue up past 1590, we would add another butterfly here at 1570. And then if it were to go to 1600, we would no longer add anything. We would just simply start taking off our lower positions here. In other words, we'd close out this 1530 iron butterfly and we would put it at a higher level, or what we call roll it up. And then from the downside here, If the market goes down, then we're going to exit this with the market below 1480. So that's how that's going to go. What we would like optimally would be for us to go a little bit higher in the marketplace, get in our last third, and then just have the market range somewhere between 1480 and probably about where it is now. And when that happens, we get the profit target quite quickly. That doesn't happen here. So let's just kind of go day by day, and we'll show you how this progresses. And one of the things I didn't mention early on is this line here, which is green, red, and blue, is what's called our T plus 0 line, or the value or the projected value of the position at any given price point on the Russell. So right now the Russell's at 1574. If the Russell goes up to 1600, this is projecting that we're going to have a $156 loss if that happened today. If it went down to say 1480, which is our stop out point, we would be up $287 if that would have happened today. That's what it's projecting. Over time, and we can simulate what this does over time by adding in lines. So we have projection lines. So I stuck in 5 projection lines, and over time, this kind of migrates towards this pink line here, and it just gains value through time, assuming we're in a certain range, right? And eventually, or at expiration, it's going to be worth all the way up into here. So let's go back to one line here so things don't get confusing. Here we are at 1574 again. We're down about $13, not a big deal. Now we get to 1589. We haven't quite hit our add point. So one of the things with this strategy is we're only checking it once a day. So it's not one of those things like day trading where you have to sit in front of the computer and you're in and out of stuff when you're looking at a million things. You can literally trade this strategy where you just kind of go in, you know what your adjustment points are. We know we have to be out at 1480. We know we have to add at 1589. I can just come in at my checkpoint time and I can say, oh, look, it's a 3:30 or whatever. That's when my checkpoint time. The market is still below 1590 and it's above 1480. There's nothing to do here. If I go to next day on the 3rd, we end up getting a very large down move in the Russell of 53 points. That may have what we call an implied volatility impact. And implied volatility can either cause it to drop down, or they could also cause it to raise more than normal too. So these analytical models aren't perfect. That's why I said this T plus 0 line is a theoretical projection. So let's move forward here. Next day, the market lightens up a little bit, and we get a nice value pop. We're up $142. Let's go into Tuesday here. We get a continued down move, but this time implied volatility acted a little bit more normally. So we're up 237. Now we get a bit of an up move. We're negative delta, but even though we got a good sized up move here, we end up gaining even more value. So we're up about $347. On the 10th, 342. About 452 here on the 11th. You can see the market's pulling back and doing this, and this is what we like it to do. Okay, if we go to the 14th, again, this is doing what we like. We're just ranging here, and over time we're gaining value. There's the 16th. Again, you're getting a bit of a move up, but we're still doing well, about 382 positive here. 532. Things are going well. And here is our first down adjustment. So like I was saying, or like I was talking about earlier, we do have some down adjustments when we start to get scaled in. And when we get scaled in and we pull back under or outside the tent to the downside, what we're going to do is we're just going to back out of the second butterfly. So right now we have this iron butterfly here at 1550. We're just going to sell that off and go back into 1/3 of a position. So let me do that. So now we dropped our size back down again. We're up $613. Everything's going fine. We're actually almost at our stop out point where we're going to just close this position at 1480 and call it a day. If we were to do that today, we would be up over 10%, which is pretty good of our planned capital. And if you look at the actual capital we have in the trade, it's only a very small amount. It's like less than $400. So that's a very good return on $400. Our maximum amount in the trade was a little more than that. The maximum amount of trade was about $1,200. So we're up about 30% of our maximum capital in the trade, but it's only going to be 10% on our planned capital. So let's move forward. We get a bit of an up move here on the 22nd. Profit and loss is 628. Then if we go here, we ended up getting another fairly big down move. So this down move put us well past our exit point. Now this is, again, one of the good characteristics of this trading strategy is we're not checking it during the middle of the day, and we have a point where we know we're going to exit at 1480. We've exceeded that point by 20 points. That's not a big deal. It's built into the numbers within the strategy and how it works. So we end up drawing down a little bit from our 670 peak valuation, but we end up closing this because we are underneath our long strikes at $583 profit, or about 11.5% of our planned capital, and about 48% of the actual capital we actually had at risk in the position at any given time. So that is the bear trade, this episode's winning trade. If you like what you see, I encourage you to join us and discover how you too can follow along with this and many other great strategies as they unfold during our Options Trading for Income webinars that are available with our Go membership. And where you can also learn about upcoming winning trade presentations and our trading success blueprint. And perhaps best of all, where you can get information about our free trading performance podcast, where you can learn to become a much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see in the next winning trade, we'd love to hear from you. Simply comment on this video below so we can get those questions answered for you. And we would also encourage you to come on over to thewinningtrade.com, that's thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic information on how to profit through income trading. And please remember to subscribe and comment on our YouTube channel, where I will personally answer any questions that you may have. Thank you, and we'll see you on the next Winning Trade.